to be started. Oh yes, and today is Tom Williams's birthday. So happy birthday, Tom.
Thank you.
And I'll hand you over to Tom. He can tell you all about the toys, well, not the toys, the presents he got.
Right, thanks, Peter. Yes, everybody's reminded me it's my birthday. I'm 84 today. I'm a Capricorn, a goat, in other words, and we're renowned for supposed to be stubborn and never giving up. And funny enough, I do have a little bit of those traits, I know. I've had loads of cards and people ring me up and all the rest of it. You know, I'm not a great celebrator of birthdays. But anyway, that's it. So let's get back to business. Okay, now we've had this long break over the festive time, the Christmas and the New Year. And to be quite honest, we've taken that opportunity not to look too much at the charts. But they can see my chart, can they, Peter? 4 hour. This is a 4 hour chart of the S&P. Yeah, the S&P future. And it's, the only reason I put that up is that it gives you an idea of the overall, how it's been moving in the last few days, especially over Christmas, look. So it gives you an insight in more or less what it's been doing. Now, here we had, of course, back here, somewhere here. Oh, I can't find it now, but we had a markup on the news from America that, oh, that's it there, look. That was the markup there, look, on the news that the American Congress had sorted their finances out, or started to anyway. And on that news, it's gapped up, look. Okay. But markets don't like ultra-high volume and up bars. And the very next bar, look, it is up, it's a blue bar, but they've got massive volume. That means there's supply present in the market. So although they gapped it up, there is supply present. We do have a sign of strength on the immediate next bar. So that's also there. So we got supply in one hand and support in the other hand. Now the fact is that those two bars would have made that market run sideways, look, up to now today. So it's gone sideways, right? We had the markup. Markets don't like this ultra high volume and up bars. Whenever you see that, right, it's not the time to chase the market. Okay, it's gone up a little bit there, look, and basically it's gone sideways. The volume is nothing over the holidays, look, naturally, market's closed. This here must be the new year, look, low volume. And it's just jogging sideways. Now the first sign of life that I could have seen here would be this fairly high volume here, look. Not long ago. And that looks, it's on that bar. So that looks like supply is present. But from experience, you've got to be very wary of these markets, because although you've got the high stopping volume here, which more or less knocked it sideways, but it has, look, the very fact is it hasn't fallen is also an indication there must be some built-in strength there somewhere to support that market like that. Now, knowing that, are we going to have an upthrust? Are we going to have a move up suddenly, close on the lows as a trap upthrust, marking the top of the move? I would not be at all surprised if we don't see that. I don't say we're going to, I say, but if, you need to be ready that if these things happen, you more or less know what's going on. but you can't trust your own judgment. You can't trust your own gut feeling with these markets, because either consciously or subconsciously you can't help but absorbing all the news. Now, even I was speaking to Philip Friston this morning, and even Philip said this morning that he is not going to listen to any news at all during this next year. He said all it does is it doesn't mean anything really, the news, and all it does, it tends to mislead you. Your subconscious mind is listening to this, although you say, oh no, I don't listen to adverts, I don't listen to anything. Your subconscious mind is busy at work absorbing all of this. And if you're not careful, you will form a gut feeling. And you could bet your bottom dollar that gut feeling won't be correct. So you have to be very wary. I've always said you can't trust anybody in the stock market, and you can't even trust yourself because of that. And all the time I've been in the market, you can never, ever trust other people. I'm sorry, but they'll put their needs first over yours. And never, ever hand your money over to somebody, no matter how clever they sound, to trade your money for you. That's a very, very poor idea. Believe me, you have to learn to read the market. And once you learn to read the charts, right, then your skill as a trader kicks in. And then you don't need anybody else, right? So anyway, the market's gone sideways. Now, there is some ultra-high volume or very high volume suddenly appeared here. How long ago was that, Peter?
Well, this was
4 hours.
The bar closed at 4 o'clock this afternoon, so an hour and a half ago.
Hour and a half ago.
It's a 4-hour bar.
So that is a weak bar. So I'd be very, very careful here. But the 4-hour chart, look, gives you a good overall view. It's almost as good as the daily chart, look. But what we do, we'll have a look at the 7-minute chart. Can you put a 7 up? Thank you, Peter. Right. Okay, so there's a 7-minute chart. Now, you can look at all these different time frames. Right, you can look at 8-minute, 9-minute. You can look at them and see how it seems to work for you. Now, this 7-minute, somebody put it up in the office. I thought, oh, that looks interesting. So I normally don't look at the 7-minute. But here we are, look. Markets don't like this high volume. Here, look, on these up bars. And even that one, look, it's closed in the middle. So you know you've got some weakness embedded in there. Right? It goes up, and then we start getting what we call weak bars. Weak looking bars. There's a yellow box up there. No, you see, the way the software is organized is that it'll come up with a yellow box if weakness is detected, but it won't actually throw a proper signal up with a dialog box, and next bar is confirming it by being down. Now, we did that. Sometimes it's better for people, clients looking at it that way. But the whole idea really of the signals, automatic signals, is so you can learn or get used to what these signals look like. And then in the future, you can look at any chart, whether the signal's there or not, and you'll be able to read it. The reason here is, look, first of all, you've got an up move. That's important because they're not going to distribute or sell if there's no up move behind them, is it? Will they? That's the first thing you've noticed. Secondly, there is some weakness in the background. Right, professional money, be fully aware of that. How are they marked it up, look. And here's the high volume again, look. There's a high volume again, look. Right, and then we've got followed by weak looking bars. especially that one there, look. So these are up thrusts and signs of weakness. Right, and so on that weakness, it's knocked the market sideways, look. But although you've got some supply hit the market, and although you've got weak-looking bars, it's being supported, look. Now, they could still have an upthrust to trap you. If that is genuine weakness and genuine distribution, they could very, very easily have an upthrust. That means they can mark it up, catch all the thousands of stops that is above these future contracts, trigger them off. So they're actually trading away from the true value, and they do it very quickly. Right, then it will close on the low usually. The volume will probably be lowish, showing it was a genuine markup. And then you could short that. That would be weakness. And as these markets fall, you'll see the red trending system kicking in. And if you look at those down moves, you'll see how persistent those red down bars are as it's falling. And you might look at it and just not think too much about it. But it's done deliberately. That's not by accident. Those professional money do not want to let anybody that's trapped in at the top out. And they know what they're thinking. The herd will be locked in, and they will be waiting and saying, oh God, I wish I'd have sold at the top. Anyway, when it goes up, I'm getting out of this. Now, the professional money know human behavior, and they know what they're thinking, and that's why those red down bars are persistent like that, because they're not going to give you a chance to get out of your position without paying some money to them. So that's why it's always very, very, very important that if you're long and you get it wrong, you must close your position immediately without any hesitation. There's no point praying, wishing, hoping, talking to your broker, nothing like that. You just got to get out, because the proof is in front of you. You can see it all the time. When these markets fall, there's persistent red down bars. And of course, it's the same for moving up. Once these markets decide to move up, they don't want people jumping on the wagon and enjoying the ride up. So they make sure that each bar is up, and that's why they're colored blue like that. And that's done deliberately. It's not accidental. That's done deliberately. Now, this is a 7-minute chart. It seems to be quite good for scalping. If you're interested in scalping, you know, it's got signs of strength here, look. Came in. Right. Okay, read those dialog boxes. So you catch a ride up, not for much, but a few bars, but you get another sign of weakness, a weakness up here. No demand. Right, and you've got some strength appearing here. Test. But you can see that you've got to be fairly sharp when you're scalping. And then this is a fairly good, strong giveaway, this one, because these shakeouts, they all look the same. We've spoken about shakeouts time after time, and that's what they look like. The market falls for a few bars, and then you get this gigantic down bar, right, on a wide spread down, right. The news will be probably bad, if there's any around. It'll close on the high, and the volume will be, well, here it's just above the average, but it doesn't look all that strong. Now, funny enough, this shakeout, you've got a sign of strength on the immediate bar in front. Can you click on that? No supply. So they know there wasn't much supply in the market, right? Sorry, Rita, what?
Come back to that level. You see this massive volume here? And it's come
Yeah, that's true.
low volume.
Now, Rita's pointed out it's not perfect, but you've got down bar here, look, with very high volume, look. Okay, markets don't like that. Right, but that's a down bar. If it was an up bar, it'd be bearish, but it's a down bar. So it must mean there must have been some buying in there, but also supply. So it pops up a few bars and it comes back down to that level, look. And it's this bar here, when they see the volume is low, the supply that was obviously apparent here, I'll just draw a line across there, has disappeared. Now professional money would have seen that, so I think, oh right, good, so there's no supply, so we'll have a shakeout anyway. We'll ram it down, catch all the stops, put the fear of God in anybody that happens to be long, right? And that's what's going on there. I know it's very easy to see in hindsight, but if it was there in hindsight, it must be there at the leading edge. So, but this is a 7-minute chart. So sign of weakness here, but it just caused it to go sideways a couple of bars. So it is quite good if you're a scalper. Excuse me. But there's the up thrust that we saw, right? And it's that weakness there, high volume on the upside, look, followed by these weak looking bars. They're up thrusts. Now, that's caused the market to go sideways, look. Now, they're fully aware of professional money that there's weakness there. But don't forget, you've got this shakeout behind you. So it's probably a little bit of no man's land. It's not advisable to do anything unless your principle is clear to you. I would say definitely don't trade if you can't see the principle clear. Now we're just looking at one chart here, but there are no end of different charts available that you can look at. And that's why I usually recommend that you tend to specialize in just a few rather than trying to cover so many charts you don't know whether you're coming or going. But I would be very, very cagey. It's a Friday, right? So they can't trust them because they know that the results of today are going to be in the newspapers and on the news, the money programs. They know all that. And they want to mislead you as much as possible for trading for start next week. Now, please, if there's any questions, we're here to answer. Rita's looking for...
Mark did say 5 minutes, but it's not much different to the 7-minute, is it?
Right, I put somebody said if Mark said if...
Yeah, like 5 minutes.
Yeah. Now it's the 5-minute chart, look. There's your high volume coming in. Right, it's knocked it sideways. Here's your no demand, look. It's drifting forward up. Right. So it's being held up, the market. There is supply there, without question. But there is support as well. Now, how the professional money support the market is they don't actively sell on the downside. But when they're bearish, they're not supporting the market. And that will cause a market to fall in a persistent way. But they seem to be supporting it. Now, Friday, be very cautious Friday. Incidentally, Gavin Holmes is doing his Detective Holmes. We call it for a laugh the final bell.
One's called the closing bell.
Closing bell, but we say, oh, he's doing the final bell. Poor Gavin. But he'll be doing them this evening. But we mentioned that because Rita didn't think it was advertised. Somebody said it wasn't on, but it apparently is. And so please, questions.
Just one point to make for people to recognise this
Oh, yeah. Now, that's right. Peter's just looked at this. Peter's very keen on trading now, especially when he's making money. Right. Right, so this is now, it's a bottom reversal look at the 7 minute. And that here, down bar, will be on low volume.
So another one, the previous one.
Yeah.
Supply,
Yeah. Now, I said it has to be on low volume before I even looked at it. These red down bars, right, they will be on lowish volume. That's a bit bullish.
Got a question from Mark.
Right, yeah.
Well, you were talking about them holding the market up, Tom. Mark says, could they be holding it up there while they are deviously selling?
Oh, too true. Oh, too true. They hold it up, right, so that every time an up wave comes, small one, they sell into the up wave. In other words, that's how they distribute. They've got to distribute any of their holdings on as the market's moving up. They can't do it as the market's moving down. It has to be moving up. And that's usually hallmarked by no demand or it looks like an upthrust. But that's what they do. You just have to get the feel of it, knowing what they're doing in the background, but be very cagey about Friday. And don't trade unless you see something obvious.
Yeah, do send your questions in, and Tom will endeavour to answer them. If you've got any charts, if he gets the data for it, then he'll look at it. But there are some names here that I don't recognise. Is there any people here who are new to VSA? Yes, Rick is new. Okay, we have certainly one person who's totally new to VSA. And Nick is, pretty new. Yes, we've got 3. I noticed I've seen there are some new people here, Tom, who probably might need you to explain some of your the principle. And the other one from Mariano, I can't answer that question about when are you sending mentorship course. That's something you need to ask them at TradeGuider themselves, Gavin Holmes or support at TradeGuider. I don't know about that. So yeah, there's some new people.
Right, thank you for that, Rita. Right, addressed to all the new people. I tried to explain in a few words as possible the principles behind what you're looking at in the chart here. Now, the first thing you need to realize is, I apologize to all the old timers that listen, they've probably heard this 100 times, but you can't really hear too much about it, to be quite honest. But there's no question about it that there is a professional element of work in the stock market, which, let's face it, there's a professional element in every business. No matter what business you've got or do, you might think it might be a hobby, but it isn't. There'd be professionals in there. And when you hear the word professional, or when you hear the word smart money, right, what they're referring to is traders that can throw in 5,000 contracts into the arena and follow other groups, or other groups follow you. In other words, that there's firepower there, serious firepower, right? We're not talking about the small-time people. We're not talking about my trading, Rita's trading, or Peter's trading, or anybody else. We're talking about serious, what they call smart money, Gavin says, right? And that alters when they come in and they start putting that kind of contracts in, or that money into the market, right? It will alter the balance of supply and demand. until another thing happens. In other words, they're taking it out or selling, right? So that definitely goes on. There's no question about that. And we have these automatic signals that appear, and if you think that they're pretty good, once you understand them properly, then if you think they're good, then that means that the instructions given to an automatic system that comes up without the intervention of any human being at all, right? If you think they're pretty good, then we must be telling you the truth, because computers do not understand flaws in your thinking. Computers simply do not understand you getting it wrong. You've either got it right or that they don't want to know, right? That's if you expect signals to look pretty good. In other words, fairly accurate. So you can be rest assured that what you're looking at is in fact the truth, is in fact what goes on. And so it's professional money moving into the market, which loves sums of money. Now, you've got to get your head around a little bit more. Imagine if you're one of these professional traders, then obviously you want to get you want a reasonably low price. So you don't enter the market until the market has fallen somewhat, right? You may see 1, 2, 3, well, more than 1, 5, 6, 10 bars down, red down bars, and eventually, right, they'll decide, now the market is vulnerable. It's dropped low enough. I think we can make a little bit of money here. And you see them coming into the market. It'd be on a down bar, and the volume will be high. And we call that stopping volume. In other words, volume is activity. And their activity, they're the only people that can make that activity high like that. And then the market stops dead on that activity. But it's usually too early. Perhaps unless you're trading currencies, it might be slightly different. But we're not talking about currencies at the moment. So you see stopping volume. Now you know professional money's entered the market. And it may even start going up for a few bars. But what we're looking for then is the market to fall back down into the area or the level where you first saw that high volume coming in, what you call stopping volume. Now, if you're observing that and you see the volume is low, don't forget volume is activity, is low at that level. When surely, if you think about it, that must mean that the selling has gone, disappeared. Right? And if the market moves on supply and demand and there's no selling, then it must mean they're bullish. Because you saw stopping volume to the left. It curved up a little bit, then dropped back down into that level. And the volume is now low, or activity is low. So you immediately know, right, that the market must be bullish. And then you can go long, but you don't go long unless you see these principles and you understand what you're looking at, because it's a very, very dangerous place. And they just love to catch you. And then if you catch an upright, right, you can follow the trending system. Don't get out too early, which most people do, until you see supply hitting the market. Like we saw on that chart when we said, look, the supply has hit it, it's going sideways, and there's some upthrust. Market looked weak. That was at 7 minute, wasn't it? Yeah, put the 7 minute back up. Now, time frames, it doesn't matter, oddly enough. Now, how I explain these different time frames, right? I try to explain things in kind of a simple story so that people can get their heads around it to start with. Imagine you're a doctor in the hospital and there's a patient coming, he's got typhoid, pneumonia or something. Right, so you give him his antibiotics or whatever and he's ill. Now, it doesn't matter how often you come back and look at that patient of yours, 1 minute, 2 minutes, 3 minutes, 5 minutes, 10 minutes, 30 minutes, 1 hour. It doesn't matter really. He's not going to get better. He'll get better slowly until he gets some signs that you can read as a doctor that he's getting better. And that's why all these different time frames work. But you've got to watch that, because even intelligent people say, oh, that's impossible. You can't have signals on all these different time frames. But you can, and that's the reason why, is because if the market's weak, it'll be weak throughout all the different time frames. Now, I've heard very clever people telling me that. You know, talk about even some programmers who are pretty smart guys, and they'll tell you that. So, but that's roughly what we're looking at. But don't worry if it's a bit confusing at first, because believe me, once you get into it, once you learn to read the markets, which is a little bit difficult because it's so devious and cunning, the market, it's not there to help you. It's definitely not there to help you. You know, I tell the story of the news. See, I always say I've never seen anything in the market that's designed to help the ordinary trader. Never. Right? But then somebody might say, oh, well, they tell you all the news events, like next Tuesday, 1:30, this is going to happen, or 3 o'clock, that's going to happen. Excuse me. So you've got to ask yourself a question. Why are they appearing on the surface to want to help us, telling us when the news is coming out? Well, seeing they never give you any help, and you believe that, then the next thing you realize is, of course, they want you to listen to news events, because on the news, they're going to whipsaw the market. That means drive it up or drive it down, catch all the stops, mislead as many trades as possible, usually to your disadvantage. And that's why they want you to listen to the news. And that's why Philip Friston, who's a very clever trader, makes his living from it, said he's not listening to any news next year or this year. So anyway, by the way, Happy New Year to everybody.
Oh, sorry, I wasn't reading, but while you were talking, Wayne says, Tom, is that why you are better to look at longer term time frames first, like weekly or something? That was when you were talking.
Well, it's like if you want to travel somewhere in your country, right? You don't look at a map of the town to start with, do you? You want to know where you're going. So you get a map out showing large hunks of your country, where you can see the roads marked and the next town you'd expect to come across and so on. And that's the idea of these longer term time frames, is to give you some idea where the market's been going and what's likely to do. And then you can look at these smaller time frames to see actually what they are doing. But don't forget, primarily, the things we show you here are really for scalping. But there are techniques for trading stocks and shares, which is very good. That's how I made my money, trading stocks and shares years ago. And, of course, the markets were different in those days. But stocks and shares is the safest way to trade. But you trade stocks acting stronger than the index. And you've still got to be able to read the daily chart of when that move's likely to happen. And then when you see the general index or the parent index looks or is telling you it's going to go up, then you select those stocks that have been resisting down moves or really acting as strong or stronger than the index. Those are the ones that love to shoot up more than the rest of them. Okay?
Jerry, yes, I am posting my trades, but haven't done any over the Christmas period, so that's why there's a little bit of gap. But next week, I hope to be back to it. this week it looked awful, so I didn't get involved. Nick, I don't know if Peter, you can. Nick says, can you explain volume differences between TradeGuider and, for example, TradeStation? For example, AA, could it throw up a dodgy signal? It shows 44 min on TradeGuider, yet the volume is only 7. Do you know what an answer for that one, Peter?
Yeah, hi, it's Peter here. Well, as far as the data is concerned, the data often comes from different sources, a myriad of sources, I think, sometimes. I'm not sure exactly how they do it, but clearly, for example, if you compared e-signal data with real-time data, both of which can be used to drive the TradeGuider software, you'll see differences. They could be differences in volume. They might be differences even in the close of the bar. But as Tom might want to say to you in a minute, talk about relativity or the relative values. They are very important, which is why the volume doesn't have to be exactly something or not something. And so if you're getting data via TradeStation, that volume could be again different. So, you know, these different companies who supply data, where they or how they do it, I must admit I don't know, but I have seen differences almost in all of them. But the differences are not usually major. So if you do see a major difference, then you have to ask yourself, is that data correct? Which one's correct? And if there's any particular problem with a product, go to the supplier, you know, whether it be TradeGuider or TradeStation, to ask that question, and you may get an answer. Again, you may not. Tom, anything to say about that?
Yeah, thank you for that, Peter. Yeah, the main advantage of TradeGuider is that everything on the chart is relative. That means it's looking at the previous price spreads and previous volume. Now, VSA. Yeah, sorry, the charting system. Right. So, for example, volume is activity. Now, very often, you might see the market go up on very high volume, which you know is supply hitting the market. If they've messed around with the volume at the other end, it may go up on low volume, right? But that's all right for us because that means it's spelling out no demand. So they've got to go a long way to trick us. And they do interfere with the volume, I know, especially in the London markets. Why that is, you know, obviously it must be for their benefit somewhere or other. But we use relative volume. But very important, if there's any doubt, don't forget that the price spread is very, very important. If the market's gone up on a narrow spread, you know there must be some built-in weakness there. Same as if it falls on a narrow spread, then you know there must be some support there. So remember the spread, that is the range of the bar from the top to the bottom. The close is usually helpful, but not essential, but it's the price spread that's important. But keep that in mind. So overall, I think you'll find that the software copes with all that very, very nicely. And the more experience you get, the more you can read between the lines.
We don't get intraday charts for gold, GLD.
Oh, do we have gold?
Could you put GLD up though?
Yeah.
Okay, as I was just checking. David says today GLD Gold ETF has tested the low of December 20 on lower volume. It is currently in the middle of the daily range. Do you expect higher prices next week? So Tom only has the daily charts for GLD, so he can look at, and here it is. He can have a look at this and comment that on this.
Reality, it's down here at the moment, but you can't see that.
Right, well, as soon as you look at that daily chart, you can see it's definitely weak, or that bar is weak. so you wouldn't expect higher prices. We've got lower tops here.
In fact, Tom, I'm going to just update that, make sure it's up to date. Hang on. There you go, that's better.
Oh, that's better. Yeah, so that's
up to date to yesterday.
It's up to date, daily chart up to yesterday. But this here is definitely a sign of weakness, look, without any question. Now, the thing is that this down here looks like stopping volume. Here, right? It's fallen quite considerably. It's even gapped down, look, which normally gapping like that isn't particularly necessary, fantastic, good news. But it's fallen, look, and there's your high volume coming in. It's even produced a signal, look, and we call that stopping volume.
Potential climactic action.
Right, climactic action is the same sort of thing. Right, it's still stopping volume, whichever way you read it. Read these dialog boxes. There's a lot of information in these boxes. And if you read all those boxes and study them, you'll get to know what we know, because we don't have any secrets. We don't claim to have any secrets. There are no secrets in the stock market. There's too many clever people out there. So all you can go by is supply and demand. Now, it's definitely some demand came in here. It gapped down, but look at that terrific high volume. That's stopping volume, and it closed near the high. So it went up. Market's so strong, it tried to test, look. The volume is low, look. But what we'd like to do is see the market fall back down into this level here. Here. Where that line is. We'd like to see the market fall there. If it fell and the volume was low, especially if it was colored pink by the computer telling you it was really low, then that market would be bullish. But right now, it's not bullish, it's bearish at the moment. You'd expect lower prices on the back of that daily chart. Right, but if...
As a matter of interest, what's actually happened is today, the market gaps down to around about here.
Yeah.
And there's a narrow spread currently, and the volume is less than over here.
But it's not finished.
But it's not finished.
Oh, right.
Comment till it was.
So I can't really comment on the market, gold. I'd love to have intraday charts. I've never been a great enthusiasm for trading gold. There's too many amateurs in there. You'll find that the professionally driven markets are easy to follow. But gold, there's a lot of people in there that like to trade gold. And but right now, that market on that daily chart, you certainly wouldn't want to be long at the moment. But if it goes back down to that level here, right, that's a beautiful example. There's your high volume. There's your stopping volume. It's even come up with a signal lock. If it comes back down to that level, I'll just draw a line across there. There. If that market falls and hits that line or that level and the volume is low, that means the volume is pink, colored pink by the computer to tell you it's low, then that market is going to go up. It'll go up until you get supply hitting it. Because I remember somebody said to me once on these webinars, well, how do you know you go in long? How do you know when to get out? Well, you get out when you see weakness appearing. In other words, supply is coming out. There'll be high volume and up bar. Right.
Question on this chart.
That bar, Rick is asking, is it stopping volume because of where the bar closed?
No, not at all. It's stopping volume, right? Because first of all, you see a down move, quite a substantial down move from a side of weakness right at the top. It's on a down bar, it's down into fresh low ground. In other words, there's nothing to the immediate left. And the activity or volume is very high. Right? So what on earth would cause that? It has to be professional money moving into the market. Nothing else can cause that. But before it becomes bullish, well, I mean, if you're scalping, you may go long straight away and try to catch a move, a small move up. But if there's any decent move coming, then it'll fall back down to that level where you first saw the activity, the stopping volume. It's got nothing, well, the close helps to confirm the fact is it was definitely stopping volume. Because if that had the volume been selling, why should it close on the high? We'll close on the low, surely, if that was all selling. The next bar certainly wouldn't be up. So that's what we're looking for with gold. What you really need is a sort of like hour time frame or something to trade this properly. But you look at the daily chart to get an overall picture of what's likely to happen. I mean, that's obviously a sign of weakness right there, look. Up bar, narrow spread, little or no demand, that's weakness. And it's falling. Now, if it falls here to that line and the volume is pink low, then that's going to go up. However, if you see a wide spread down on increased volume as it races towards that level, then that's weakness. But it looks, with the stopping volume in the background, that that's basically a strong indication that gold is at the moment.
Edmund tells us that the price did get back down to that level today, but volume is not pink. So the volume's a little high, says Edmund. Oh, there's a no demand. Well, the day hasn't finished, but it's not going to be low volume, is it now? It's yeah. So Tom's saying that means then that there's still supply present. Chris is asking, could you look at the S&P or the Dow over the holiday period and give an analysis, please? I'm thinking it might be best to do. We'll be doing it in the newsletter, won't we, Tom? Do you want to do it now, or should we?
Well, when the market's closed, there's not much to analyze, is there?
No, over the week.
It's been a very flat week, really.
Yep. Well, we'll be doing the newsletter tomorrow, so we'll have a look and do our best. Because over the holiday period it's been rather flat, but he'll do that in the newsletter tomorrow. There's quite a few questions here and we're running out of time. Craig says, when selecting a stock to trade, should we avoid thinly traded instruments, and if so, why?
Well, we never used to touch thinly traded stocks. And of course the reason is that the professional money, the floor traders, they're not interested in thinly traded stocks. For the reason is, of course, that it can be manipulated very easily. They can mark them up, mark them down, do all sorts of things without too much outside interference. So you want a stock that's traded well, that's, in other words, got liquidity, and it behaves itself. History of behaving itself. And, of course, the reason you trade stocks in harmony with the parent index is pretty obvious, is that the market does go up and down, represented by the index, right? And the stock acting as strong or stronger than the index shows that the professional or smart money investing in that is, when the general market's falling, they're not holding, they're not selling, they're probably even buying more or holding that stock up. And that's why it acts as strong or stronger than the index. And when the market turns around, you'll find that those stocks are the ones that go up the best and the safest for you to trade.
Mitch is asking, since stocks can sometimes drop dramatically overnight, what is your opinion of trading index ETFs for swing traders instead?
Nothing about that, Peter.
They're derivatives, essentially.
I wouldn't attempt to advise you on that because I've never specialized in that. But those instruments will follow the rules that we teach you. So it may be good. I haven't. See, all that is new stuff to me. Because when I was trading, there was none of that. All that clever stuff. But I did learn to read the charts. We had to. And that's how you make your money. But keep plugging away, and then your expertise will grow. And whatever you're looking at, if you've got the high-low close and volume, and it's fairly liquid, it will follow the rules of supply and demand. You can be rest assured over that. But trading thin stocks is not a good idea.
Question here. 3 days ago, the markets gapped up very high. Afterwards, the trading spread was shallow. Would we consider this compressed or a wide move? For who, he says. Tom's asking. Would we consider this compressed or a wide move? The major US indexes. I don't think we don't understand the question. So if you put it in if it's a bit about compressed or a wide move, for this, Tom, the major indices. Hang on. Wide. It says compressed or wide. They traded shallow after the gap up, he says.
Well, we weren't trading at the time. I think Rita was here, and suddenly gapped up on that news, which they were expecting, of Congress rubber stamped something that stopped the country going bankrupt or something or other. We wasn't really too interested. But they gapped it up on that news. After the holiday, whenever. Yeah, and then it gapped up. We're watching it, actually. We weren't worried because we weren't trading at the time. But then, of course, you've got no demand came in. They'd done what they wanted to do, and they were just coasting sideways. But they were holding the market up, as we saw on that 4-hour chart. It was only now, today, that there was a bit of weakness appeared.
Euro daily chart up, Peter. You're best on end of day, aren't you, for the Euro daily? Well, because that's not...
Okay, Eamon is asking, could you give a review of the euro on the daily chart? We're just, that's not the euro. Oh, go.
Let's go to...
Right. Go back to where you were. There you go. 6E. It's E. You might have to put in the daily. 6E. You have to put a daily up. But of course, this is e-signal, so yesterday's. It's the future. So the volume on yesterday is not. Is the volume on yesterday reliable, Pete? No. Oh, we don't. Hang on. Right. All right. Okay. Yes, that's the daily chart of the euro.
Well, at the first glance, it looks weak, doesn't it? You certainly wouldn't want to buy that enthusiastically. The reason is that it's gone up. You've got a distribution cap here, look, right across here. Must have been supply hit the market right here, look, there. Right, they held it up while it went sideways for a few bars. Then you had this trap up thrust, look. Right, it fell for a couple of days. Then another crafty up thrust, look. Right back into this area. So you've got to assume that all that was distribution. Now, if you had a point and figure chart, you could take account from there over to here where supply first appeared, and it would give you a very good indication where that was going to, where that was going to fall to. That market looks weak, and you would not be interested in buying that with a distribution cap immediately above you like that. You've got weakness here, you've got weakness here, look, what's that, no demand? No demand, look. And then this is fantastic, look. You don't see them so clear as that. That is definitely an up thrust, look. After weakness has appeared, look. And that catches thousands of stops. There'd be thousands of traders caught out with that. Right. And then bang. Widespread down. That bar there is not by accident. That widespread down like that is done deliberately to trap as many traders in that market into poor positions as possible. And that's why it's done like that. That's weakness. Weakness everywhere.
Okay, we're running out of time. This is our last question. And in fact, actually, two people are interested in accumulation and distribution. And Edmund suggests you mention it in the newsletter tomorrow, Tom. I don't know if you... Yeah, we'll mention it in the newsletter. And Chris says I have trouble distinguishing between accumulation and distribution phases, as both of them look very similar. Tom says no, they don't. So please, can you give any tips in this regard? Do you want to give a quick thing, and then we will cover them in the newsletter?
I mean, distribution, accumulation is like night and day. I mean, look at that chart now we've got up on the screen at the moment. Now you look at the top there, it can't possibly be accumulation. You've got an up move behind you. If you're professional, you're not going to buy after you've seen an up move, are you? You're going to buy into the market after there's been markets fallen. So when it goes up like that, you start seeing these signs of weakness, you know, red signals, up thrusts and no demand up bars, right? Then you know immediately that they're holding the market up and selling, distributing. And they have to do that to distribute. Now it looks nothing like accumulation because you're at the top of an up move. Accumulation has to appear at the bottom of a down move, not an up move. I mean, it's like night and day, believe me. That is distribution. You think about it. Imagine yourself as a professional trader and you want to throw in 5,000 contracts. You're not going to throw in 5,000 contracts into a market that's had a nice rally, are you? I wouldn't have thought so. You want to throw in once you see a substantial down move, so the market becomes vulnerable to attract professional money in. Well, thank you very much for your interest. And remember, we do a newsletter. Rita types it out. Peter loads it and unloads it, does all sorts of things. And I commentate on it. And if you've got any questions, please ask us, and we will do our best to answer them, even in the newsletter.
Yes, we'll probably it'll be tomorrow, will it, Tom? We'll do the newsletter. Is that all right? Yeah, we'll do the newsletter tomorrow. Thank you all for everybody saying happy birthday and happy new year to you, Tom. And Mariano, this course, why does the link not work? I can't help you. I don't, I'm not in the Trade Guider office or anything. You do need to speak to them, I'm afraid. support@tradeguider.com. That's the email, isn't it? Yeah, support@tradeguider.com. I'll put it in the thing here. Thank you very much, and we'll see you again next week, the same time, same place. Thank you. Bye-bye.
Welcome to GoToWebinar, Web Events Made Easy.